So I think Peter Lynch is my favorite investor. Look, I like Warren Buffett a lot, but Peter Lynch, when he articulates value investing, he does it so smoothly. So today I'm going to show you exactly how to use a stock screener like the legendary Peter Lynch. I'll have a list of criteria that you can use yourself, and I'll do a demonstration for you too. And if you're new to my channel, well, welcome. My videos are about investments that anyone in the world can make. And if you haven't watched my FinViz stock screening tutorial video yet, well, I highly recommend going back and watching that so you understand the tool that I'll be using today. I'll put a link here somewhere in the video. Now, Peter Lynch, he ran the Magellan Fund at Fidelity Investments from 1977 to 1990. And in that time, it returned 30% per annum. Just for reference, that's more than double what the S&P 500 did over that period of time. So he's probably not a bad person to try to copy. It was the best performing mutual fund in the entire world, and he's also the author of probably my favorite investing book, One Up on Wall Street. Now, before we jump into what Peter Lynch looks for in an investment, well, I think some of his best advice is actually not about specific investments, it's actually about the psychology of investing. So here are some of my favorite points. Investing in the stock market is about your stomach, not your brain. There is an almost infinite amount of negative news out there, and there will be serious downturns. So what is your tolerance to pain? Can you take these downturns? If you need money in 1 to 2 years' time, well, you shouldn't be buying stocks. Can you look at yourself in the mirror and know exactly what you're going to do when the market drops, say 10%, 30%, 50%? People save up and be very careful when buying a car or planning a holiday, but will put $5,000 to $10,000 in any investment business that they heard at the pub. That is gambling, not investing. That isn't research, this is just total speculation. Stocks are not lottery tickets. Behind every stock is a company. If the company does well, over time, the stocks do well, and vice versa. Selling a stock. Well, selling a stock is exactly the same as buying a stock. You create a thesis when you invest in the company, and when the thesis plays out, you can sell. The economy means nothing. Peter famously said, if you spent 13 minutes a year on economics, you have wasted 10 minutes. And what he means is that the future is just too hard to predict, so don't even bother. You will have flops. Maybe you're right 5 or 6 times out of 10. But we're trying to make sure that these 5 or 6 times out of 10 make 400% or 1000% or even more. So they make up for the flops when you do lose 75 or 100%. Okay, now let's talk about what Peter Lynch specifically looks for in an investment. Now, a company, of course, doesn't have to meet all of these different things, but any one of these is a good sign. These are the questions that Peter Lynch would ask himself when he's looking into an investment. So this is part of putting together a thesis. Let me try to explain his criteria with Nvidia, Prudential, and any other company that I can think of. Nvidia, well, they're a high-end graphics card maker. They're probably one of the hottest stocks right now. And Prudential Financial, and their corporate life insurance with poor stock price performance. So here we go. This is his list. First of all, it sounds dull, or even better, ridiculous. What he's talking about here is the actual name itself. And Prudential Financial, well, that kind of sounds pretty dull, I think. It does something dull. So corporate life insurance from Prudential Financial, well, that's pretty boring, right? But high-end graphics chips from Nvidia, well, that's not dull at all. Peter Lynch would prefer to look at the company that does something boring. Number 3, it does something disagreeable. Now, both these companies don't really do something disagreeable, but think of something like, I don't know, a cigarette company. That might be an interesting investment for Peter Lynch because people disagree with smoking. Number 4, is it a spin-off? Now, spin-offs can often be undervalued. An example of this at the moment is Seritage Growth Properties with Warren Buffett, Monish Pabrai, a lot of investors looking at Seritage Growth at the moment, and it's a spin-off of the old Sears. Number 5, the institutions don't own it and the analysts are not following it. Well, both Nvidia and Prudential have analysts following this company, but really small little micro-cap companies often don't have any analysts looking at it at all. And this would be a good thing. Number 6, there are rumors abound. It's involved with toxic waste and or the mafia, or I just try to think of some examples there. Both Nvidia and Prudential don't have rumors about them, but sometimes companies do, and the share price gets hammered because of it. Number 7, there's something depressing about it. Well, Nvidia making high-end graphics cards, well, that's not depressing, but life insurance, that's kind of depressing, right? Number 8, it's a no-growth industry. Well, Nvidia are in probably one of the highest growth industries. I think corporate life insurance is also in a growing industry, but Peter Lynch would look at, it would be more interesting for him to see it in a no-growth industry. Number 9, it's got a niche. Now, Prudential Financial, they definitely don't have a niche. There are definitely lots of other life insurance companies out there, but Nvidia, Well, they're in a niche. They have the best graphics cards out there, so I would consider them in a niche. Number 10, people have to keep buying it. Now, Nvidia don't have a bad recycle rate, so every 2-3 years when their computers get a little old, the new graphics cards come out, and well, people do replace their computers because of the graphics cards, so that's good. And well, life insurance, well, that's even better because people pay their premiums every year. Number 11, insiders are buying. Now, at the moment, Nvidia insiders are actually selling. They're not buying at all. And Prudential, well, there has been some recent buying. And number 12, well, the company is buying back shares. Nvidia at the moment currently isn't, but Prudential is. Now, if you're going to compare Nvidia to Prudential based on Peter Lynch's criteria, well, Prudential definitely passes a lot more of them than Nvidia. Now, Peter Lynch suggests that every company falls into at least one of these categories. So the company could be a slow grower. So that's a large, mature company. It's less than 5% expected long-term growth. Then you can have a Stalwarts, which are large, mature companies as well, but they have higher long-term growth rates. Then you've got fast growers. So these are small companies with really high growth rates, over 25%. You've got cyclicals, which are up and down depending on what part of the cycle they're in. Asset plays. Now, this is where the assets are worth far more than the stock price. And lastly, turnarounds. These are heavily discounted. Sometimes these companies are falling apart or in dire straits. So I'm now in the FinViz stock screener, and the first screen we're going to look at is the Stalwarts. So the first thing in the descriptive tab is we have the market cap to be over $2 billion. In the fundamentals, we've got a PEG ratio of lower than 1. The earnings per share growth over the past 5 years, it needs to be over 10%. The earnings per share growth this year just needs to be positive. And the debt to equity, Peter Lynch really likes companies with low debt, so it has to be under a 0.3. That's very low. So once we've done this screen, I've done it already, it gives us 10 companies. Now, another thing that Peter Lynch would do would be he would rule out the financial companies. He doesn't like bank debt that much. So there's going to be a lot of banks here. We're going to rule out the banks and we're just going to look past them. So here's the screen. This is very interesting because we've got the second company I see here is Barrick Gold Corporation. This has been so much in the news in the past 3 or 4 months because Warren Buffett has taken out a huge investment in this particular company. So this would meet Peter Lynch's criteria as well. Now, there are some other companies here. There's a fair few banks down the bottom here, so we've got to ignore the banks. Marvel Technology Group, I've heard of them before. Maybe there's something to look into. Biorad Laboratories, never heard of them, but maybe there's something to look into as well. So that's the Stalwarts screen. I'll have the criteria at the end of this video. I'll have it in a list as well, so you can record that for yourself. The next screen we're going to look at are the fast growers. So this is how he would screen for them. We want to have a market cap over 300 million in the fundamentals. Now, we want to still have a PEG ratio under 1, but the earnings per share growth over the past 5 years, now it's over 20%. That's very high, remember. The earnings per share growth this year just needs to be positive. We want to see a PE under 40. It just means that the really, really high PE ratios, we've cut them out. And we still want to see it under 0.3 for debt to equity. Now this gives us 21 companies. Now remember, we're not going to include banks and financials and things like that. So there's some interesting companies here. Big Lots has come up on some screens of mine before. Global Cord Blood Corporation. Now I've invested in this company. I have a video about this. So it's very cool that it's coming up here on the Fast Growers screen from Peter Lynch. What else do we have here? We have Marvel Technology and Barrick Gold again, and the rest are probably banks. So again, another interesting list here to go through, and this would be considered a fast grower from Peter Lynch. So the last screen we're going to look at today is called the slow growers screen. Now, what we've done first is we've put the market cap over $2 billion again. And in the fundamentals, we've got the PEG ratio now under a 2. So it was a 1 in the other screens, now it's under a 2. The earnings per share growth over the past 10 years, now that's under 10%. Make sure you press under 10%, not over 10%. The earnings per share growth this year needs to be positive, and the debt to equity, again, under a 0.3. And we have a list here of 13 different companies. So again, he doesn't like looking at the financial sector, which is most of these, as you can see. There are some insurance companies here that I've looked at before, which I think are some fantastic deals, MFC in particular. But Peter Lynch he'd actually rule out all the financials. So we've got Belcham Corporation. No idea what they do, but we could look into what they do. Oh, and down the bottom here, we've got Armaco, which is U-Haul. You might be familiar with this if you're American. It's the company that you use for storing things and transporting when you're moving house and things like that. That's a very interesting company, very stable company. It's obviously a slow grower because it's come up on this screen. And yeah, that might be a very interesting company to look into a little bit more. If people are going to be moving around America a lot, this company is very popular. So here are the metrics for you to screen like one of the best investors in the world. But remember, this is just a starting list. You still need to develop a thesis and do far more research into a company. And who knows, maybe you find something here that Peter Lynch would also love to see. Maybe none of them are good enough. I'll leave that for you to decide. And something I also like to do when looking into the screeners is to just play around with the filters. Now I'm back in the Stalwarts screen at the moment, and I might just want to play around with some of these criteria just to loosen them up a bit to get more companies. So for the market cap, well, maybe I'm happy to make it over $300 million in size, not $2 billion. And in the fundamentals, well, look, that debt to equity ratio is really low at 0.3. It would be fine if it was 0.33 or 0.35. So let's make it under 0.4. And look, it's actually made it now, there's 46 companies. So this gives me a way, way bigger list of potential stalwart companies that would be good investments. So that's what you need to do. You need to play around with these tools a little bit and don't be so strict. And hey, if you enjoyed this video, please make sure to hit like and subscribe to my channel so you don't miss out on any of my future videos. And I will see you next time.